It is very expensive to be poor. Imagine you work at a minimum wage job. It's a struggle each month for you to make it from paycheck to paycheck. You don't have a bank account because banks have long ago abandoned your low-income neighborhood, and because you don't trust them. They charge punishingly high fees for minor mistakes. Without a bank account, it's hard for you to save your money. But not only that, you have to pay fees just to use your money. You are one of the 40 million unbanked Americans who spend 10% of your income on financial transactions. To put this in perspective, this is how much low-income Americans spend on food a year. Now imagine a different scenario. Like nearly half of the United States population, you have less than $500 in savings. With so little to save, you feel like you're always just treading water. This month, you stumble. Your car breaks down. You don't want to get evicted. You'll do whatever it takes to feed your kids, but you need $500 to fix your car. And you need a loan to recover from this financial setback. Where can you go? Even with a bank account, the underbanked have to rely on payday lenders and fringe lenders. These modern-day loan sharks charge interest rates of 300 to 2,000%. So you needed $500, but by the time you're all is said and done, you've spent $2,000 in interest and fees. And you've entered into a cycle of debt as you borrow from one lender to pay off another. Not only does this crushing interest make it hard for you to pay off these loans, it could ruin your credit and lead to your bankruptcy. You were looking for a lifesaver, but what you got was an anchor that submerged you into debt. Whose fault is this? Sometimes I hear people saying that the problem is financial education. But this assumes that the poor take out these loans frivolously and that there's another option that they could go to. But there is nowhere for them to turn. I'm a banking scholar, and I can tell you that banks are no longer interested in making small loans and taking small deposits. There's a disparity in the banking system today. There's a mainstream, regulated, federally subsidized banking sector that serves the middle class and the wealthy. And then there's a Wild West hodgepodge of unregulated lenders that serve the low income at very high costs. How did we get here? Over the last 30 years, there was a merger wave in the banking sector that completely transformed banking in this country. So America used to be dominated by a multitude of community banks, and today there are only about 5 or 6 that dominate. In other words, in about 30 years, Bailey's Bank lost to Potter's Bank, and then Potter's Bank got sucked up into Bank of America. Once the community banks left, and they left the low-income neighborhoods first, they created banking deserts. And as soon as these banking deserts were created, the payday lenders quickly filled this void. But even as community banks are dying, we're still stuck in this myth as a society that the answer is community banking. Every law enacted to address this gap has been about promoting community banking, but it hasn't worked. It's time for us to match the scale of this problem with a large solution. Other people are looking at financial technology, or fintech, some new innovation that will fix this problem. And tech will make banking cheaper and easier, and that will help. But as to core banking, which is saving and borrowing, technology is not the answer. Because banking requires trust. Trust is the currency of banking. Banks use other people's money to operate. And for this to work, you need trust. And historically, the only institution that can provide this trust has been the federal government. So while we can innovate around the details, this essential government-bank relationship hasn't changed in hundreds of years. In other words, when you want to save your money, you'd rather do it at a dusty old institution that's been around for 100 years than a nimble startup that might not be around in 10.